right, welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, covering everything from core fundamentals to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Shupp, Head of Investor Relations at Focus Capital.
I'm Chad Sheeler, founder and president of Post Capital.
So far, Chad, we've talked about the upside of real estate, cash flow, diversification, and long-term wealth. Today, we're focusing on the other side of the equation. What are the risks of real estate investing? So, real estate is often described as the safer or less volatile. Why can that be misleading?
Yeah, I think for the most part, real estate is a safer alternative than other investment classes. Um, when you look at risk and returns, higher levels of risk, you should compensate for that and get higher returns. However, where it can be very risky is if you have, let's call it bad assumptions, you pay too much for a property, you have inadequate reserves, wrong kind of debt in the property, that can make it very risky. So real estate, just in essence, as a whole, shouldn't be perceived as, oh, it's low risk, buy the real estate all you can. You have to do something smart about it. You have to analyze risk and make sure you're mitigating risk wherever you can to make sure it's going to be a viable investment solution.
I think that when it comes to risk, we can even break down. There's different types of risk for investors and the main categories that I think that investors should understand is market risk, execution risk, financing and interest rate risk. Some of the things you just talked about, liquidity risk, and operator risk. In previous episodes, we kind of talked about how to evaluate an operator and the questions to ask there. Which of those 5 risks do you think that investors underestimate the most?
Limited partner investors, if we're talking about that, LP investors, I think they underestimate how much risk there can be in financing, although it's pretty commonly known now after the last few years. But I think the operator risk and the execution risk, those two are probably the largest ones that people misunderstand. Because they can look at a business plan that's value add, for example, and the goal is to buy a property that's in an area where you can grow the rents, you can improve the property, do renovations, and get this rent bump, right, by renovating certain units. I think people underestimate how much extra risk that does carry, which we've done very well at that in the past on a lot of properties. So we know how to do those, right? But there is extra risk, like construction risk, renovation risk, risk to get that rent bump that you think you're going to get people to actually pay that, and then to stabilize a property over the next year, 2 years. There is a lot of risk in that.
Yeah. I think just even to take one half step back, kind of just give a brief overview on those kind of 5 primary categories. Most people understand market risk or have even heard of market risk, especially because that market risk is there in the if you're buying your primary residence. But if someone is completely new to real estate, how would you describe, market risk in 1 or 2 sentences?
Market risk would be, does the market have more jobs coming in that are going out, right? Is there increase in jobs there, increase in population? Is there increase in jobs means increased demand for housing?
Yeah.
So if there's always increased demand for housing and there's not more supply coming in than there's demand for it, then you should be okay.
And that's where that kind of anecdote of location comes from for anyone that's investing in residential or commercial. Like whenever somebody talks about location, that is a subset of market risk.
Yeah.
Execution risk we'll talk about, especially from an operator's perspective. You just kind of talked about financial and interest rate risk.
That's a big one too, very big.
And so when it comes to liquidity risk, especially when it comes to LPs, kind of talk to me about that. What is liquidity risk? What even is it?
Without being prefaced ahead of time, I'd say liquidity risk is really how liquid are you to withstand the storms coming up. And that's a mistake I've seen people make the last 5 years. A mistake that I made initially on some smaller deals is that underestimate how much in reserves you have to have in a property, because you never know what could come up. I bought a property, almost 4 years ago, that within 3-month period of time, we had a insurance claim over 6 figures. We had to replace the entire roof, $180,000. We had a fire in one of the units. A lot of stuff happened in the first 3 months. It was like, holy cow, what just happened here, right? So you got to plan for that, though. You got to plan to have reserves and to plan for the unexpected.
I think there's 2 sides to liquidity risk. The side that you just brought up, and that's something that we also deal with here at Focus Capital is like we have a property right now that it is cash flowing, but because of something, the financing side of things, like preparing for amortization, like we are holding on to certain cash reserves. That is a liquidity risk that we are mitigating because we don't want that date to roll around and us to be caught, with our pants down. And so it behooves our investors to have less or lower distributions for us to be able to hold on to that cash flow to address a broken roof or amortization. I think the other side of liquidity risk is more maybe accurately described as exit risk. So if you go into a deal, especially as an LP, but even as an operator, when you are raising for a deal with an exit in mind, let's say that the timeline is 5 to 7 years, like a lot of our properties are, how are you monitoring the market risk in that area? How are you going to ensure that you guys are going to be exiting at the projections that that you raised on, and what that's included in an investor perspective? So I think that liquidity risk is both the ongoing risk and then an ending risk from an exit perspective.
Yeah, I definitely agree. I mean, and as far as the exit risk there, that's a whole different topic probably to talk about. But always analyze the market to see where your valuation's at with the other comps in the area. Like, yeah, you might plan for a 5-year hold, but it might be 4, it might be 7. You never know.
And operator risk, we kind of talked about in our last episodes of like, is this person experienced? And by experience, we don't just mean number of deals, but are they aware of these risks that we talk about? Is this their first deal? Or is this their second deal?
Well, do they bring the risks out forthcoming in the initial presentation? I think that's important. That way, we all know what the risks are. Just go ahead and say them.
Well, I mean, that's a great point to lead into like, how do experienced operators think about risk differently than new operators or even newer investors?
That's a great one, actually. That's really good. Well, they've been through a number of deals. So they've experienced, you've done more than probably 10 deals, I guess. So they've experienced risk and they've learned ways to mitigate against that. I'd say a lot of operators, they look at risk as what could prevent me. Okay, back up a second. One of the biggest things that experienced people tell me that I've heard is that the number one rule is to keep the property from the bank. Like, don't let it go back to the bank. So if you have time on your side, if you've got a good debt structure in place, you have liquidity reserves, you've got a business plan that you've got cash flow in. If you have cash flow and you're not relying on just appreciation, you can withstand storms. You can go longer and still the property can still remain in your possession, right? We're just calling it how it is. If you've got very short-term debt, you have no reserves, you have loss of habit in the property, and you've got a balloon in 3 years, like you have higher risk to lose that property back to the bank. So learning how to maybe do lower leverage debt, be better capitalized, have a less aggressive business plan going into it. Maybe don't overpay for the property. These are all things you can do to lower that risk to make sure you own it for a long period of time and you can withstand storms because real estate comes and goes in waves and valleys.
Yeah, I think those are definitely risks that experienced operators just kind of know from a muscle memory perspective to consider. Going back to the question of how do experienced operators think about risk, any type of risk, differently than new investors and new operators, I think that one of the biggest things is not that you had said earlier is not just thinking about the risk, but being transparent and communicative of the risks up front. I think that a lot of new operators and new investors are hesitant to talk about them because it will show inexperience. Where here
it's opposite.
Here it's like and nothing's perfect, and projections aren't promises. Here's where we're projected to be. Here's where we currently are at. Whether that's ahead of the projection or behind the projection, and if we're behind, why?
I think the best investors, they've always asked me, what are the risks in the deal? Like what could go wrong? And tax benefits. And what happens if you pass away? I'm being serious. Like, what's your succession plan? So I made one of those for the company. So they think about they're thinking about risk. The best investors think about risk overall. So as an operator, lead with ways to mitigate risk. Lead with how can we preserve the capital first, and then return second.
Yeah. See, speaking of mitigating risk, do you think, and I think we both know the answer to this question, and it should be relatively obvious, but do you think that there is ever a way that risk can be fully eliminated, or is it just more about management and structure?
Oh, that's a great question, and I'm still racking my brain here. You could maybe go invest in a money market account, but still has some risk to it, though.
Mhm.
You can't limit it.
But in our industry, there's no
No,
way.
you can't. You
There's
can't.
and that's comes with any type of investing. I'm not even saying like real estate. When we're in real estate, any type of true investment carries
Yeah,
risk, and but everyone who knows basic finance knows that higher risk, higher return, and that's why you're getting compensated for risk. Now, there is a medium, there is an equilibrium point, real estate being one of them, where you have control and you can mitigate certain risks. The other thing is if you're invested in public markets, you have no control. You have control of when that you buy or sell, within certain reasoning, but like you just have to sit and watch and monitor and then actively monitor your portfolio. Here, there is ways to create some management and structure, but we both know that there's no way to fully eliminate risk. And anybody who is raising on that type of thesis where like this is completely risk free,
yeah,
like I think that's a big red flag.
yeah, yeah. It is. I always tell investors, like, look, you'll never have 100% of the data like figured out.
Hmm.
We even won't, right?
Hmm.
We have to operate going into it, probably having 85, 9% of the answers figured out that what we think will happen. There's still going to be an unknown of 10% or more that you just don't know yet. You've got to use your best judgment through data and your experiences and lessons learned to make the right investment decisions.
Yep. So going back to the kind of investment operator side of things, stuff that the other Chad here does, how do conservative underwriting and margin of safety factor into risk reduction?
Yeah, it just gives you more cushion, really. Like for example, if you underwrite a property with going from the trailing 12 months to the end of the first year to increase your revenue by double, just hypothetically, right? That's pretty aggressive. Like you would have to literally on day one double everyone's rents essentially for round math here to get, which is not achievable. You can't do that.
Hmm.
So if you if you know what you think you can achieve in a market with rent growth, or maybe it's not rent growth, maybe it's you're going to add other income, or you're going to decrease expenses, or have a certain amount of vacancy allotted for, or maybe get a certain rent bump, and maybe you dial that back a little bit, then you have some cushion there. You can sleep at night. One thing we've always tried to do is leave about 4 or 5 different areas of conservativeness in a business plan to where these 4 or 5 areas, like, okay, for example, rent growth, maybe we know based upon market data that we can probably achieve 3% per year on average in this market. Let's just say it's 2.5, or maybe the first year is like only 1%. Just dial it back a little bit. Like, okay, if we can go actually beat that, then we're going to be great. Or we're going to be outperforming. So the whole goal here is like we take a few areas that where we believe we probably can do better. We dial it back a little bit and base the returns upon that. So in our mind, it's a base case scenario we're presenting to investors with the intent to outperform.
Hmm. I mean, flip side of that coin, what are the risks of being too conservative with your
You
underwriting
don't
and stuff like that?
you don't
I
get any
mean,
deals.
yeah, you don't get deals. I mean,
There's a balance. There's a
yeah,
balance.
for me, I think, especially with my role here, if we're too conservative with our underwriting, and especially when it comes to the returns aspect, no one's going to want to invest here because there are the people
Yeah.
that aren't conservative. They're super aggressive. And so if you're going to juxtapose a super, super conservative deal and a super aggressive deal, you're like, I'm going to make double with these people. Why would I ever give you my money? And so basically getting to a point where we're having accurate enough projections where we're going to be able to meet those targets, but then also be able to exceed them a little bit from good operating, from good management structure, from good asset management. So,
Yeah.
for passive investors, which risks should they focus on the most closely?
I think focusing on the operator risk right there and the market risk is probably two of the bigger ones.
Hmm.
Financing risk comes along with the operator risk. Like, did the operator choose the right debt structure? Did they choose the right loan option, right?
Hmm.
So that would be more of a function of what was their choices made by the sponsor.
Hmm.
But I'd say, yeah, the market risk, the operator risk, two biggest ones.
Yeah. And if you kind of pay attention to the operator risk by default, they should be also paying attention to the market risks too. So you're going to
Yeah.
have kind of like a double safety net there. I think it's also important for us to note that this is not a comprehensive list of every single risk. We're talking, pretty broad general. This is a 15-minute or less podcast on Fridays, but I think the risk in real estate isn't about avoiding uncertainty. It's about understanding where it comes from and whether you're being compensated appropriately for taking it as an investor.
That's correct. Because maybe later episode here, but it's funny because people look at different deals that have different levels of risk. And some people are focused on just IRR, which we'll have a different podcast on this later on. But what they aren't thinking about is like you should be getting compensated for the risk you're taking. And also lower risk deals should be a lower return. You can't look at it just a return metric and say, oh, this land speculation deal over here is going to give me a 18%. This is going to give me a 15%. Well, what risk is there? What work's there to get done to actually get that return? You get it, right? So
yeah,
that'll be a different episode.
Yeah, speaking of a different episode, I think that tees us perfectly up for next week's episode, where we build on this by talking about the specific questions that investors should ask before committing capital to a deal.
That's great.
Yeah.
Let's do it.
Perfect. Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.